So here we are again, one day up, one day down. We have bad news basically every 15 minutes. And underneath the surface, the data is telling a very specific story. So this week, we are going to walk through the numbers, what the indexes are doing, what's happening in Korea, the oil market playbook, and where the real pockets of strength and weakness are hiding. So let's go into it. All right. So let's start with the cross-asset overview. We see a lot of red over the last 7 days, but this time it's international markets leading the way down. Emerging markets -8%, silver down -7.6%. All country world, ex-US -6%. International stocks -6%, and so on and so forth. So we see for the first time since a few months relative strength of US stocks, and surprisingly we see digital assets equity slightly up, but Ethereum up 2.7, Coin 50 up 3.7, and oil, the big story, up plus 20%. So we had these attacks on Iran from the US and Israel, and of course that caused a lot of volatility in the markets. Let's start with S&P again. So you see it's kind of a topping pattern where we are in. Nothing dramatic yet. Also, if you look at the Nasdaq, it looks better than we would have thought, but also the Mag 7, is around support line again. So the whole thing looks more like a mean reversion story at the moment. And I come into a second to the oil story. But it's really about outperformance of US stocks and the strong underperformance of emerging markets. Here you have emerging markets against S&P 500. Yeah, there was a huge run up. There was a huge correction now. We are right at support, and I think it holds. But let's see. A similar pattern for international stocks against the S&P 500. And also you had value giving up against growth. Yeah, so that's the growth value ratio. When that thing is going up, growth is outperforming. So it's more a mean reversion story, and especially Asia got hurt a lot. So if we look at volatility, you see the implied volatility here for different asset classes here, or different regions, right? We have the WIX, we have gold, we have emerging markets, we have international stocks, ex-US, and we have long bonds. And you see that that was the tariff drama last year. You see purple, US is doing relatively well against international stocks, and we have even more volatility now in the emerging markets, and we have for several weeks now a very high volatility regime in gold. And so basically the whole attack shows that Asia is suffering more, Europe is suffering more than the US, which is more energy independent. And so we had huge moves in the KOSPI. And so I did an analysis here this week. Yeah, so Korean stock had the worst single day crash in 44 years. right? Almost 8 standard deviations if you normalize that with a set score. Um, that's huge and more dramatic than the 9/11 aftermath, dot-com crash, Asian financial crisis, and so forth, right? So foreign investors sold 5.4 trillion Korean won, so that's approximately $3.7 billion on a net basis in a single session. And retail investors absorbed a similar amount on the buy side, repeating a pattern from recent sessions. Yeah. Um, so despite this historic sell-off, KOSPI is still up a lot. And key driver is Samsung Electronics and SK, two largest components of the index, and track the KOSPI lower as the memory semiconductor cycle showed signs of turning. Yeah, MECI Asia Pacific fell 3% on the same session, and that was also largest single day drop since April last year. Yeah, so we see second order effects on global memory semiconductor stocks that could be significant, right? So mean reversion story here as well. Of course, we also have to look at oil. Where do we have it? I think I prepared it somewhere or not, so I have to type it in. Yeah, you see, unfortunately, that crude is not going down. It's going up. And so it's pushing to new highs. And the history gives us a framework for thinking about what comes next. Yeah, so if we look at the Gulf War in 1991, oil was already rising sharply before the invasion. After the war began, oil took roughly 2 months to reach its major top and then spent another month forming that top before beginning a prolonged decline. Also, if you think of the Russia-Ukraine war, Russia invaded Ukraine on February 24 in 2022. And again, oil was already elevated before the invasion. After the war began, oil spiked for the next 2 weeks into a major top, then spent 3 months forming that top before declining. Yeah. Why do I say that? The pattern in both cases, the oil market correctly anticipated the conflict, but had only priced in roughly half the total move at the time war began. And that's important because where we are now, US officials have stated the current operation could last 4 to 5 weeks. If that timeline holds, history suggests oil could reach a climatic peak before the campaign ends, and the market is counting the conclusion in advance. So in terms of positioning context, most indicators are not yet at the extremes seen at prior major oil peaks. Yeah, so that's something we have to keep in mind. And the longer that goes, the tougher that will also be for inflation, right? So there's a Fed study that every $10 rally in oil prices can increase inflation by 20 basis points. So you see what that could mean. And that's also no good message for bonds and also basically no hedge from bonds this time. Yeah, you see 10-year dollar yields are going up. Japanese yen, 10-year, JGBs up. UK also up strongly. Yeah, yields. And also bonds, German bonds, up rapidly, right? So there is no hedge from the bond side. No surprise because market is expecting a higher inflation, especially the longer that takes. And also, what does it mean for the dollar? I think that was the only safe haven we had this week was the dollar. And the US dollar is breaking out through key resistance. And I think 100 is the next target. But also, it's not a critical or a traditional risk of dollar rally. And here's the tell. If you look at the yen or Swiss franc, they are both rising. Yeah, dollar yen, dollar Swiss franc. Where do we have that? That's here. Both are rising. And in a classic risk-off move, you'd expect the yen and Swiss franc to strengthen against the dollar. So the fact that they are not suggests this is a structural dollar move driven by the US position as an energy independent economy at a time when energy prices are spiking globally. And that's very interesting to observe here. Now, interestingly, what does that mean for software? Now we had software. We talked about that. They crashed a lot due to the AI fear, and suddenly they are doing a hard rally here. So again, we are speaking about mean reversion. We are now at an interesting level where I expect a pause, but that also brought a mean reversion in all these private equity things, right? Private equity, private credit, all suffered a lot. Look at Apollo. They also rallied now. We have credit spreads tightening a little. Yeah. Here high yield is coming down or related to the private credit story. And here's a good comment, right? BlackRock slashes another private loan from 100 to 0. And that's a loan on a so-called Amazon aggregator that buys up online sellers of products from spa treatments to light bulbs, right? So if you can't value such a simple business, how on earth can you value the AI business? And everything is dependent on the promises from Anthropic and OpenAI delivering $1 trillion in revenue each. And I don't think that's realistic. So I wouldn't, as I said, it's a mean reversion story. Now I think this Damocles sword hanging over private credit is there over the hyperscalers. There is overinvestment. They won't have these revenues, although Anthropic rose a lot. But I think this $1 trillion in revenue promises are not realistic. And with software, we also had a recovery in Bitcoin. And so last week we were right around the 67 level. Now we are above. So Bitcoin is holding quite well, but you also have to think of it, every bear market has strong bear market rallies of 30 to 40% in Bitcoin. Yeah, so I wouldn't be surprised if we go back to the 80K level. But I think still longer term, this bear market has to play out as it always plays out, right? And if you look at our projection here, and that's based on our crypto heat index or sentiment index. So every path here is a 1-year path whenever the crypto sentiment, our heat index, is between 0 and 10. And what's really interesting is that the white line, that's the current Bitcoin price, is beautifully tracking the 10% percentile line. So just 10% of those moves were lower. And you see the median line is higher. And of course, there's a huge dispersion because there's a huge volatility in crypto and in Bitcoin. But you see the median expects Bitcoin to be at the beginning of 2027 around 140K. But that assumes that we go back to the median path. Yeah. Now we are following the bear path, which is just 61K in 1 year. That wouldn't be so nice. But generally speaking of time, can also see that August, September could mark the low of Bitcoin, which also reflects a classic 4 year cycle again, right? So I wouldn't be too quick, but if you have no exposure, certainly the next months could be a good opportunity to pick up crypto. But it really depends on how quick this resolves. And if you analyze, so that's a LinkedIn post I did, if you analyze the first 6 months after these oil-related conflicts, you see there's just one clear winner, which is gold, where the median path is up. Oil, normally people buy at the peak here. All right, it's up at the beginning, then down heavily. And the big question mark, of course, is how equities behave here. So generally speaking, I would be careful. Also, the dollar is normally down because it hurts the economy, the US economy. But this time, as I said, it seems that the US economy is more independent, energy independent. And so it's hurting more the others, right? So from a volatility level, you see emerging markets is compared to a year ago more at the extreme level. But if you look, for example, at the VIX curve, it can get much more dramatic. Yeah, this 3 month versus the VIX contract, the spot contract. Yeah, so you see last year, yeah, the curve went much more in backwardation. Also, when we had this yen carry trade debacle, I think it's too early to say that we are in the all clear mode. And yeah, it's at the moment it's a volatility level where it's not high enough to have enough buffer and security to get a nice 1 year return forward rate. At the moment, it's high, but it's, in my opinion, too uncertain to say that this is over. Yeah, so we really have to observe that. Yeah, normally adding exposure, adding risk is much better about the 30 towards the 40 level, and we are not there yet, right? Emerging markets, yeah, is higher, but also we have to watch the oil story. Is it over in 4 weeks? Does it take longer? Also, a negative sign is that banks in the US have broken the 200-day moving average. That's really weak. That's also not a good risk indicator. So overall, we have choppy declining markets. They don't end with a gradual stabilization. They normally end with a sharp compressed rip off the band-aid move. So the typical sequence is you have extended period of chop, where's down bullish, where's down bullish positioning and psychology. Then normally you get a mini panic, forms the actual low, lasting only a few days. And the news at the bottom is maximum bearish, which is exactly what makes it a bottom. So the irony of these setups is well documented. By the time the actual low print, sentiment has been damaged enough that few buyers step in. So that's something we have to wait for. The current setup is, it seems that institutions are still reducing positions. Credit spreads haven't really turned. VIX hasn't spiked to levels historically associated with capitulation, as I mentioned. So the process appears to have more time to run before those conditions align, right? But I have to say, it's interesting how crypto trades at the moment, but also I think that's a mean reversion we have together with software. So if you find that useful, please smash the like button, subscribe, and I see you next week. Thank you very much.